Welcome to all of you who have joined us for this PIM webinar today. My name is Frank Place. I'm the director of the CGIAR Research Program on Policies, Institutions, and Markets. And today we're going to hear a very interesting topic, the title being, Do Medium and Large-Scale Farms Generate Income Spillovers for Rural Households? The Case of Tanzania. This work is undertaken by PIM as part of our research flagship 2, Economy-Wide Factors Affecting Agricultural Growth and Rural Transformation. We have two people joining us today for this seminar. One is Jordan Chamberlin, who will be presenting the webinar, and he's joined by colleague Tom Jane. So I'll introduce both of them right now. So Jordan Chamberlin is currently a spatial economist at the International Maize and Wheat Improvement Center, or otherwise known as CIMMYT. He's based in Nairobi, Kenya now. However, today he's visiting East Lansing, Michigan at Michigan State University. He was formerly an assistant professor of international development and a member of Michigan State's Department of Agricultural, Food, and Resource Economists Food Security Group. He joined that faculty in May 2013 and was on a long-term assignment in Lusaka, Zambia with the Indaba Agricultural Policy Research Institute. He conducted collaborative research and training on microeconomic analysis of smallholder livelihoods in Zambia and elsewhere in sub-Saharan Africa. Previously to that, he was actually a scientist also with my host institute, the International Food Policy Research Institute, where he was based in Ethiopia. And previously, he was in the Peace Corps in Paraguay. So he's moved around quite a bit in his career. With Jordan at East Lansing is Tom Jane, who is the University Foundation Professor of Agricultural, Food, and Resource Economics at Michigan State University, and co-director of the Alliance for African Partnership, which is a university-wide initiative to promote long-term collaboration in Africa. He is also a co-flagship leader of the Flagship 2, which I formerly mentioned within PIM. Before handing over to Jordan, let me explain how we work these seminars and webinars, that is. So our speaker will begin very shortly with a presentation that you will see on your screens. The presentation will last for about 30 minutes. During the presentation, we invite the listeners to send in questions via the chat and or question windows on the right side of your screens. You'll see those. We collate the questions and group any that are similar in content, and then we pose them, 2 or 3 at a time sometimes 1 at a time to the speakers, and they will respond. We handle the questions in this way to make the best use of our 1 hour together. We are recording the webinar and we'll make it available on our website shortly after the live event for those who are unable to join or would like a replay. So with those few remarks, I will hand it over to Jordan.
Great, thanks very much, Frank. Very happy to be here and alongside my colleague and co-author Tom to talk about some work that we've been working on for a while. So in this study, we addressed the question posed in the title of the presentation, which is, do medium and large-scale farms generate income spillovers for rural households? And we're asking this question using a case study of Tanzania. And I should say before getting into it that while many aspects of this study are very simple, we do think it's a fresh and I hope exciting empirical approach to a question that's come up in one form or another in the kind of development literature over the past few decades. So I hope you enjoy it. By way of motivation, I guess what first started us thinking about this question was the recognition that while as a kind of stylized fact, we expect that ag productivity growth results in poverty reduction, and in many cases that in fact does take place, but you've also got cases where that's not happening. So Zambia is kind of a classic example of a country with pretty pronounced ag productivity growth, but with very stagnant levels of rural poverty. So in kind of scratching our heads over that, what kind of explains where this relationship varies from the standard case? We wondered whether or not differences in asset inequality were kind of part of that story. And so that really got us focused on this question. This also links with a longstanding view in the development literature that land distribution patterns in particular, so within kind of, this superset of assets that we might think about inequality, we're thinking in particular about land distributions. And this idea that land distribution patterns influence how agricultural productivity growth affects economic development. So this idea has a long history going back to pioneering work by Bruce Johnston, John Miller, Michael Lipton, Hans Binswanger. The basic idea has to do with the role of the multiplier. So in relatively egalitarian land distributions, we would expect that there are larger multiplier effects as the benefits to productivity are recycled kind of more intensively in local economies. So kind of another way to give an intuitive version of that, taking the other case, if land is relatively concentrated under a few larger farms, to the extent that productivity increases are taking place in that landscape, most of those benefits are likely to be retained by relatively few members of that landscape, if you like to think of it in those terms. Now, against these ideas, there's also increasing evidence of fairly rapid changes taking place in the farm size distributions in many countries in sub-Saharan Africa. Some of my colleagues here at Michigan State have done some very interesting work kind of documenting the rise of domestic investor farms, many of which are kind of medium scale emergent farmers. And so putting all of these things together, we've got a ripe case or a good rationale for really wondering what the implications of these changes are. To give you a sense of what some of the changes in farm structure look like in Tanzania over the past few years, what this table does is kind of assembles information about the distribution of farms in different farm sizes. So in the table, the rows there, we've kind of divided up all the farms in the sample into different categories of farm size. So 0 to 5 hectares, 5 to 10 hectares, 10 to 20 hectares, and above. And then look at how the relative numbers of farms and the land under those farms have been changing across this data set. And so this is the first and third wave of the LSMS data from Tanzania. So it's a relatively short period of time. The first wave was 2008, 2009. The third wave was 2012, 2013. And kind of summarizing kind of some of the things to observe in this table is that while there's been growth in the absolute number of farms across this period of time, the distribution of those changes has been kind of noteworthy in at least one respect. And if we move over to the rightmost set of columns, the percentage of total operated land on farms between 0 and 100 hectares. So in our whole sample, what we see is that there's been a migration of land under the very smallest category of farms to the larger categories of farms. So to make that more explicit, between 2008 and 2012, the percentage of the total operated land in that system under the very smallest farms, our 0 to 5 hectare category, went from 62.4% to 56.3%. So that's a decrease of just over 6%. And there's a corresponding increase in the relative shares, of course, in the other farm size categories. So this net shift of land from smaller farms to larger farms, even as the total number of farms in all categories is growing, is something that we want to pay attention to. Now, 6% may not seem like a very large number, but bear in mind, this is just a 4-year period of time that we're observing these changes over. So this is a pretty striking structural change. So given these changes, our main question is, how does land distribution, or the inequality in access to land, condition how economic growth occurs in predominantly agrarian areas? And our focus here is on the per full-time equivalent. So you'll see FTE in a number of these slides, and that stands for full-time equivalent, and it's a way of kind of normalizing labor. So our focus is on per FTE income in both agriculture and non-farm sectors. The hypotheses going into this, our a priori stance is that it could go either way. So if concentration of land holdings implies lower multipliers, then we would expect that our localized measures of concentrated land ownership would be associated with lower incomes. On the other hand, if larger farms facilitate access to inputs, to services, to markets, either directly or indirectly, then we might expect that concentrated land ownership would be associated with higher incomes. So this is really what we want to test in this study. So just a few acknowledgements of how this question or similar questions have been addressed in the literature. Rebellion and Dat's very influential 2002 study showed that the percentage of landless households significantly affected the elasticity of poverty to non-farm output in India. Bolrath's 2007 study used national data to show that the rate of agricultural productivity growth was inversely related to the Gini coefficient of land holdings, again at the national level. Gugerty and Timmer's 1999 study was also a kind of national level study and found that in countries with an initial good distribution of assets, both agricultural and non-agricultural growth benefited the poorest households. But in countries with bad distribution or more concentrated distribution of assets, economic growth was skewed towards wealthier households. So a priori, we've got some evidence kind of supporting this stylized story of concentrated asset ownership resulting in lower multiplier effects and kind of being a less virtuous landscape, if you like. So in this study, our research approach is as follows. We, first of all, get the best data available on farm size distributions. In this case, we're looking at Tanzania. We then use those data sets to develop alternative measures of land concentration or inequality. And I'll talk about the measures that we focus on in this study. And then we examine the degree of correlation across these alternative measures and also across the same measures developed from alternative data sets to see how much variation there is. And finally, we develop and estimate per full-time equivalent income models, where our goal is to assess the influence of localized land concentration on per FTE income across time and space. And we're also paying particular attention to distributional effects or distributional patterns in this relationship. So I'll show what that looks like as we get into it. So a few words about the data we're using. There are two data sets that we're kind of fusing here, two nationally representative data sets from Tanzania. First is the National Panel Survey. This is the LSMS data. We're using the first three waves. And in our balance sample, we've got a little over 2,000 households that have all the variables we need and kind of show up in our data set. And alongside the National Panel Survey, we've got the Agricultural Sample Census Survey from 2009, which is a very large sample. So there's almost 53,000 small and medium farms that show up in this sample, as well as a complete census of all the large commercial farms in the country at the time. So arguably, while we're using the NPS to get to kind of see what's going on the individual farms, discern the individual's labor allocation between farm and non-farm activities, we're using that data set to construct our outcome variables of interest in most of the right-hand side elements as well. The ASC is where we're getting our arguably better picture about what localized land concentration is looking like in the different parts of the country where our sample is. Now, so I'll be referring to these two different data sets through as NPS and ASC, as you'll see there on the screen. So the LSMS data, we're calling the NPS, using its local name there, and then the ASC is the Agricultural Sample Census Survey. So there's a lot going on in this slide, but I'm just going to try to hit the main points, and hopefully it will make sense to everyone. So we start off with the farm level production function, where our outcome of interest, Y, is gross income per full-time equivalent for farmer I and community J at time T. And that's a function of household level characteristics represented in the vector X there, as well as local geographical context characteristics. So that's the vector C. We've also got G in there as a measure of access to local public and private capital stocks in community J, and I'll say more about that in just a second. And then finally, epsilon is our error term. So our conjecture here is that the kind of the magnitude of multiplier effects is conditioned by kind of the stock of and the distribution of assets, in particular land. So unobservable access to local public and private capital stocks is conditioned by the observable local distribution of land control. So G there for community J at time T is a function of I, which is our measure of farmland distribution in the same community at that time, as well as other factors which may also influence that outcome. We then substitute our expanded version of G into the production function to get an estimable version of that. And again, we're using the ASC to define this key right-hand side element, our measure of localized land concentration. We look at a number of different ways of measuring this, in fact, much more than what we'll talk about here today. In the paper, just to keep things manageable, we focus on 5 different measures. So the Gini coefficient, skewness, or the third moment of the distribution, the coefficient of variation in farm size, as well as the percentage of land under farms of 5 to 10 hectares, so these kind of medium scale guys, and then the percentage of land under farms of 10 or more hectares. So all that's coming from the ASC. All the other elements of our data set are coming from the National Panel Survey. Again, we've got 3 waves. We use a number of geographical controls, access to markets, rainfall, et cetera. And because we've got panel data, we're able to address some of the endogeneity concerns here. So I don't have a separate slide on that, but we can just kind of enumerate what the main concerns are. And then if conversation takes us in that direction, we can go into more detail. But the main concern here is that we may be facing some endogeneity concerns having to do with omitted variable bias. So if there are things that we're not controlling for that are driving kind of localized land concentration outcomes, or the outcome of farm holdings within a local area, which are also influencing the outcomes of interest in our models. So in per FTE income measurements, then that's a problem for us. So in terms of the time invariant factors, because we've got panel data, we're able to use panel estimators, and the panel estimator that we focus on in this paper is what Woolder just called the correlated random effects model. This is basically the Munlach-Chamberlin device, and the basic idea there is that by including the time averages of all the time varying components of our model, we're able to control for the time invariant unobserved heterogeneity that may be causing us a problem had we not controlled for that. In addition, we may also be concerned about time varying factors that may be affecting our variable of interest and our outcomes of interest. To address that, we have dummies for agroecological zones, which we're interacting with year dummies for the 3 panel waves. And so that's kind of soaking up a lot of that variation. We're also including seasonal measures of rainfall, which are varying year on year. So we've got some controls in there as well. So we think we're on pretty good ground here, but welcome to be challenged on that. So the outcomes of interest, I think we've already covered this, but in terms of dependent variables, so again, these are per FTE income outcomes that we're looking at, and we're looking at them in different categories. So we're interested in agricultural income per FTE, non-farm income per FTE, and then as a separate kind of subcategory of the non-farm subgrouping, if you like, is the agricultural wage income, which you might think would behave quite differently than the non-farm wage and business component of income. And then finally, the aggregate of all of those, are total household income per FTE in that household. All of our outcomes are measured in real 2010 Tanzanian shillings. Let me now skip to kind of our right-hand side variable of interest and just kind of walk you through how we're kind of thinking about this. So to start off with, we said, well, so what would, if you could kind of think about, you know, how land concentration might look like in different stylized landscapes, what would that mean for the way that we measure it, right? So what these different figures are showing are some synthetic landscapes, if you like. So we've just kind of populated these landscapes with farms of different sizes and different distributions of those sizes, and then calculated alternative measures of concentration. So the Gini coefficient, the skewness, coefficient of variation, et cetera, and then asked how they would change as we kind of look through, look across these different landscapes that are kind of telling us something that makes intuitive sense about what we would expect to see as we think about landscapes that are increasingly dominated by larger farms. And one of the things that we found in going through this exercise is that, well, all of these different measures are kind of moving together with one another. They don't move identically. In other words, the different concentration measures, it matters what you choose, because they're not all kind of tracking equally across these different changes in landscape as we move from relatively unimodal to more concentrated distributions of land holdings. Another way to see that is by examining the correlation coefficients of these different measures at the national level. And here, again, what we see is that while most of these alternative ways of measuring land concentration are highly correlated with one another, they're not perfectly correlated with one another. And so from the get-go, we're interested in kind of making sure that we take a number of different alternative measures in our empirical assessment of what's going on, because we've got some indications right up front that how you measure this will have some influence on the analytical conclusions that you draw about that relationship. So jumping now to some of the key estimation results. We're looking here again at the impacts of farm structure on per capita income. So all I'm showing here are just the coefficient estimates of interest. So, you know, bear in mind that there's a very big kind of set of regression results behind all of this, and you're welcome to peruse those in the paper, which I think is online. If it's not, we can send that out to everyone. And it's also online at Michigan State as a working paper. But just to orientate you to what's going on this slide, so the upper panel there, so this is showing kind of the coefficients of interest from models where the dependent variable is the household farm per FTE gross income. And the 6 different model specifications there differ only in the measure of land concentration that we're using, right? And so all the other elements of the model which are not being shown are the same. And again, you can look at those, or we can talk about what they are. But the basic story coming through here, and to be honest, we were a bit surprised by this because it went against our a priori assumptions, is that most measures of land concentration are statistically significant and are positive. And we'll talk about how to interpret those numbers in a second. But basically, we're seeing evidence of positive spillover effects or positive multiplier effects in all of these different measures of land concentration. And again, in the top panel, we're looking at farm per FTE gross income. So that's true for the Gini coefficient. That's true for our measure of skewness, the coefficient of variation, the share of land under these medium scale farms between 5 and 10 hectares. Now, if the first kind of stylized finding is that land concentration seems to be a virtuous kind of landscape, you know, there seems to be some positive impacts of having larger farms in your landscape. The second stylized finding that's very robust across all of the different alternative ways of looking at this that we've taken is that those positive benefits tend to peter out as the size of the farms that we're focusing on gets larger. So in other words, if you look at the bottom row of that first panel, the coefficient estimates for the share of land under farms of 10 hectares or more is no longer statistically significant, or no longer distinguishable from zero. And so again, the stylized or intuitive understanding of what's going on is that diversity of farm sizes is good, but only up to a point. That as farms get very large, that the positive benefits of having those farms in the landscape on the incomes felt by the smaller farm components of that landscape begin to dwindle, okay? So we see a very similar story as we look at our other dependent variables of interest. So the bottom panel here is looking at household total per FTE gross income. And again, across most of these measures of land concentration, we see a positive and statistically significant coefficient estimate. So land concentration seems to be doing good things in terms of conditioning total per FTE gross income outcomes on households in that landscape. But again, that's only true up to a point. Once you start to examine the share of land held under farms above 10 hectares, those benefits are no longer apparent. Now, the point of this slide is to kind of signal that there's nothing magical about that 10 hectare threshold that we're using to distinguish between medium and larger scale farms. We experimented with a number of different categorizations to see if there was a kind of natural breaking point. And I guess the short answer is that there's no, there is no natural breaking point, but we do see very clear evidence, very robust evidence, that the positive impacts of concentration are localized in these medium scale farms. So whether we measure that as 5 to 10 hectares or 5 to 20 hectares, even 5 to 50 hectares, we see benefits there. But once we take that upper tail of the distribution, concentration under those much larger farms is no longer discernibly positive in terms of its impact on per FTE income outcomes. So what that graph on the left is showing are the coefficient estimates. So the point estimates as well as the 90th percentile confidence interval around those estimates for the different measures of land concentration, which are all summarized in the table on the right. So these are the same numbers there. And so column A, if you're looking at the graph on the left, this is our kind of our baseline results, and so it's the same as what we saw in the previous slide. Is that we're seeing a positive impact of concentration of land under that medium scale category, if you like, and it's not distinguishable from zero for the larger farms. But as we vary the thresholds or even the number of categories, we're seeing different versions of that same overall story. I can tell you about some other ways we've kind of examined whether or not these results are robust, but it seems to be a fairly consistent story no matter how we kind of vary our empirical estimation strategy, at least on that particular point. Now, the second question that I mentioned at the outset that we wanted to look at was kind of the distributional side of this story. And so what we've done here is interacted the land concentration measure with wealth terciles defined for all the households in our sample from the NPS. And basically what you can see, again, the table is only showing the coefficient estimates of interest, so it's showing the land concentration and those interaction terms. So the baseline, the base category is defined for the poorest tercile, and then we include interaction terms for the medium and the wealthiest tercile. And the basic story coming through all the different specifications, so all the different measures of land concentration, is that spillover benefits are increasing in wealth of the household. In other words, the larger or the wealthier the household, the more easily it's able to take advantage of the positive spillover benefits of being in a landscape with larger farms. In fact, there are zero or negative spillover benefits for the poorest tercile. So we see that, for example, in the measure of skewness, where the coefficient estimate for the base category is negative and significant, and it's positive for the other two tercile interactions, and larger for the wealthiest tercile. And so again, a very consistent story there. So quite a pronounced distributional aspect to this relationship. Now, the numbers are a bit hard to interpret, or rather the coefficient estimates themselves are a bit hard to interpret because they're all based on measures or indices that are defined in different ways. So one way to kind of boil that down in a more intuitive way is to simulate the impact of changes in land concentration on total income and farm income, and that's what this table is showing. So for total income, what we've done is first predicted the average per FTE income for using our estimation results for these different measures of land concentration when they're fixed at the 25th percentile of the distribution across all the districts in Tanzania, and then do the same thing for the different measures of land concentration fixed at the 75th percentile of the distribution across all the districts in the country, and then compare the difference. And so what we see, for example, for the Gini is that the average per FTE income goes from 4,300 to 6,300 as you move from the 25th percentile of concentration up to the 75th percentile of concentration. So that's a difference of 2 million, because I'm normalizing by 1,000 here. So that's a difference of 2 million Tanzanian shillings. Or when you render that as the difference, or if you translate that difference into the percentage of the average per FTE income, so that's 112% gain in your average per FTE income levels as you move from the 25th percentile of concentration as measured by the Gini to the 75th percentile. Sorry, that's a bit wordy. I hope that the main idea comes through is that as we kind of simulate the impacts on per FTE income, as we move from relatively low levels of concentration to relatively high levels of concentration, we see that the predicted changes in per FTE income are quite high. And we see a very similar story, although smaller in magnitude, but similar in its patterns when we look at farm income as the outcome of interest. And so we're doing the same exercise here as we're kind of modeling what the farm per FTE income levels would be at the 25th and the 75th percentiles of the distribution, and then looking at what the predicted changes in those outcomes are. So to summarize the main results of the paper, there's quite a bit more there, but for reasons of time, we'll leave it at that. So let me summarize. First of all, we found that farmland concentration is positively associated with rural household incomes. And this is true for farm, agricultural wage, and non-farm income sources. That the positive impacts, in particular, from the share of land in the district under farms of 5 to 10 hectares. So these kind of medium scale farms appear to be driving that overall relationship, but benefits are smaller and less statistically significant in districts with a relatively high share of farmland under farms of 10 or more hectares in size. So again, that these benefits of land concentration appear to have limits. A fourth finding is that the poorest rural households in our sample are those least able to capture the positive spillovers. The greatest income benefits accrue to households in the upper 2/3 of the wealth distribution. Now, of course, this includes the majority of rural households by definition, but it's a strong distributional story, so worth paying attention to. Now, one thing that we haven't been able to do in this study, but we think would be really worthwhile to invest in going further with, is to better understand the underlying mechanisms for these relationships. So again, our study is not able to kind of uncover what those relationships are because we don't observe them directly, but we do have some indirect evidence about what some of those things might be. So in a recent paper by my colleagues Nick Sitko and Tom here, looking at the emergence of medium-scale farmers in Zambia, they found that medium-scale farmers, again, in this in the previous slides, those would be the farms in the 5 to 10 hectare range. These often come from the same social or ethnic backgrounds as their neighboring small-scale farmers. There's more extensive social interactions with the local community. Other channels that may be important may have to do with kind of direct hiring in of ganji or other kind of agricultural labor in local environments. And it may have to do with using similar input and output channels. So the presence of larger farms may kind of attract and strengthen upstream and downstream value chains that are also of benefit to surrounding smallholder farmers. The implications of this research is, well, first and foremost, that farmland distribution matters for the shape of rural growth. There have been rapid changes taking place in farm structure in the region, and land policies are not articulated with ag growth strategies. So this kind of disarticulation is probably something that should be examined more closely. At the same time, we need more empirical work. So our study, while it's very compelling in some ways, it's just the tip of the iceberg to a certain extent. We'd like to replicate our results in other contexts to understand how generalizable this story is. And again, as we just mentioned in the previous slide, we need some more work to better understand the mechanisms of these positive spillovers. So this has implications for survey design. Standard sampling frames for rural household surveys are underrepresentative of the largest farms and don't allow for kind of persuasive calculation of local land concentration measures. So, so revisiting how we build our sampling frames could really shed some more light on these relationships. So that's all I put together in the main slide, but happy to take questions and we can drill down on any particular aspect that our listeners would like to talk about. Thanks very much.
Great. Thank you very much, Jordan, and to Tom for the very interesting presentation and for the interesting study that you've done. I totally agree that this is a very important issue and one that needs a better empirical foundation in other contexts. I think just for the listeners, there's previous work, I think, by Tom, Jane, and Jordan as well, who have been documenting this increase in the medium-scale farms that are coming, that are opening up in many countries, not just Tanzania, and often from the urban-based wealthier households that are purchasing and land in the rural areas. So it's not just particular to Tanzania. So it's great to have this presentation. Let me start off with just a couple questions I had. Just when we're trying to understand why this phenomenon is happening, and maybe there could be nuances even within Tanzania, I was wondering if you had some additional data to see how a couple of other variables might have affected the relationship. One would be the length of time that these larger farmers were occupying. I don't know if your ACS data set has that, or if you could piece that together. I mean, one might surmise that the spillovers could grow over time when the farms are more mature, say. The second one was related to crop type that was chosen. I mean, do we know more about these medium scale to larger scale farmers? Are they growing more high value crops, for example, or are they growing the same kinds of crops that the smallholders are growing? And that might have implications for whether there's more wage demand or whether there's expansion of these input markets for crops that are similar. And then lastly, I was wondering about about productivity levels of these larger farms. Could it be the case that the very largest ones are actually not even cropping most of their land, whereas the medium scale farmers tend to crop all their land and generating high productivity? So just those, I wanted to see if you had any reflections on those.
So great questions, Frank. I mean, so to be honest, we in early iterations of this work, we did look a bit at crop type and tried to keep this, that's kind of dropped out of the mix just to try to tell a focused story, but it's probably worth going back to. I'm not sure if the ASC contains information about how long farms have been around, but that's another great point as well. I think both of those things we should look at. In terms of productivity levels of larger farms, so we haven't looked at that with the ASC data. We could do that. We have looked at kind of change levels and changes of productivity by size of farm in the NPS, in the LSMS data. And it's a noisy picture. I'm not sure that there's a clean way to summarize that. A lot of the larger farms are more productive, but I think you're right that a lot of those larger ones are also sitting idle, or they're using less of their land. I think more work needs to be done to kind of disentangle what farms are doing what. Tom, you've done a lot more work on this. Perhaps you'd like to jump in.
Hey, everybody. Frank, thanks for those questions. The only part I'd like to add on is that we did look at crop types in different work apart from this one. So I can say that the medium scale farms are not really doing things that are very different in terms of crop composition than small scale, perhaps surprisingly. So because they're bigger farms, they tend to do row crops more rather than sort of, intense intercropping. So we see a lot of land in medium scale under maize and soybean rotations, rice in areas where rice is applicable. And then in some areas, we found a lot of tree production, logging trees for construction materials. So I was kind of surprised to find that. But in general, the crop types are the basic row crops.
Okay, good. Question came in. Just wanted to reflect more deeply about this result about in terms of most of the spillover effects going into the medium and the wealthiest terciles and not to the poorest households. Can you explain more about why you see no spillovers or very few to the poorest, or even sometimes negative, I guess?
Yeah, okay. This is Tom again. Most of you have probably heard of Thomas Piketty and this book that was very I think it was on the New York Times bestseller list a few years ago. It's called Capital. And Piketty's thesis was that wealth inequality has all sorts of very direct effects on patterns of investment and patterns of consumption, and all of that ultimately affects incomes. And his thesis was that the more concentrated the distribution of wealth became, it was sort of, concentrated in ways that made the poor less able to access those, the sources of income. So, think about Guatemala. You have these huge latifundia farms that are, going like gangbusters, and meanwhile, you've got the majority of the rural population landless and unable to really benefit from the growth that's occurring on these bigger farms. So you can hark back to those kind of narratives to get a good kind of understanding of why when there's wealth, when there's money circulating in the rural economies that's being spent by the bigger farms and medium to bigger farms, that those will tend to raise the demand for businesses, local rural non-farm businesses, that the wealthier segments of the rural population are able to benefit from. So I think that's kind of the reason why we're seeing what we're seeing. But let me emphasize one more time that that the effects were positive for maybe 2/3 of the rural households.
Right.
It was really just the bottom third where we saw, and I mean that's an important fact, that the bottom third weren't really cashing in on the benefits of these bigger farms being around. But the fact that 2/3 of the rural households were benefiting from this in some multiplier way, that kind of surprised us.
Yeah.
And when we looked at what's happening in areas where these medium scale farms are concentrated, they're pulling in input retailers to go, to invest in the area. We saw a rise in tractor rental markets coming in. We saw large-scale traders investing in these areas, and when they invest in these areas, it benefits not just the medium-scale farms, but all the farms around them. Their market access conditions improve.
Right.
So these are the kind of investment patterns that we think are kind of happening in areas where medium-scale farms are dominant, and so most of the rural households seem to be benefiting from those kind of things, even though, as you say, the poor are the least likely ones to be benefiting.
Good. Great. Anything to add to that, Jordan? Or?
Well, no, I mean, I fully agree. I think this is where, if we're able to get some better empirical insights into what those mechanisms actually are, we'd start to disentangle that a bit. I mean, if all the kind of positive spillover benefits were confined to kind of, to hiring in labor, then you would expect that the poorest households would be kind of the benefiting, relatively more than the wealthier households. But because we see the opposite, that kind of suggests that it's triggering these changes in supply chains and all these other services that's really kind of what's going on. But again, we need more data to really verify that that's the case.
Great. So we had a question came in. Just a quick question about your agroecological zone dummies. They were just wondering what was the source of these dummies. Are they how are they reflective of rains or other kinds of variables, or where did you draw them from? And is there and also, was there information on both long rains and short rainy seasons in the LSMS survey?
Okay, so the agroecological dummies that we use, to be honest, I can't recall the zone. There's a few standard zonations though, okay. And so that should be in the paper. So the key constraint here was that we couldn't use very localized zonations because we're already kind of bringing in our key variables of interest at the district level. And we also did a parallel set of regressions using land concentration measured at the regional level. So we needed to get something that was, another set of controls that were, fairly coarse and didn't map directly onto those admin boundaries. And so the agroecological dummies that we used, I think there are no more than that. I think it was 7 or 8 different zones. Again, if that should be clear in the paper. There could be other ways to do that. We've also got a control in there for whether or not this was a bimodal or a unimodal rainfall area. So that's controlled for, and then we've got rainfall itself as a control there. Okay,
good. Another specific question came in, I think, when Tom was reflecting about what the medium scale farmers were producing. A question, and you mentioned the trees. So a question came in about wanting to know if you had any more information on that, whether those were eucalyptus plantations or similar types of woodlots. Is that what you were finding?
Yeah, for the timber industry and construction industry in towns. So because of a rapid rise in cities, there's massive demand for construction materials. And when we interviewed some of these farmers to understand why they were growing these eucalyptus trees and other kind of sources of wood for construction, they cited demand for urban housing as being among the top sources of demand for that.
Okay. Well, let me come back to the results now. So these are very interesting results from Tanzania. Is there anything particular about Tanzania where these results were obtained that you might expect different kinds of outcomes in other countries where we have this similar rise of medium scale farms? Or what would your predictions be if you were to replicate this study in some other countries?
That's a good question. I mean, I'll start and then pass it over to Tom. Yeah, I mean, I think so. First of all, I think that the nature of kind of large farm investments is probably strongly place dependent, and it's going to depend on kind of the legal environment that's or the kind of institutional setup that has allowed that kind of investment to take place. I wouldn't be surprised if some areas have a much more kind of speculative orientation to large farm investment than others. In terms of specific predictions, gosh, no, nothing really comes to mind right now.
I think that's a great question, and I have a prior about this. I think that we're in areas where medium-scale farms are rising by acquiring new farmland that's not involving displacing existing small-scale farmers. In areas like that, I would suspect that this is more like the Tanzanian model, that the benefits could be positive for everybody. But where land is being acquired by medium-scale farms that it's involving displacement or even like expropriation, then I'm sure that the effects are going to be much more negative. And so places where displacement has been recorded in the work that we've done are places like Malawi. There has been some of the medium-scale farms that we interviewed. I think 30% of those medium-scale farms acknowledged that they had acquired land that was previously being used by other, small-scale farmers. So Rwanda might be a case like that too, wherever it's very densely populated to begin with. But in places like Tanzania, Zambia, maybe northern Mozambique, et cetera, where there may not be major displacement or any displacement, just expansion of medium-scale farms from formerly uncultivated land, then I think that our hypothesis would be that the effects could be much more positive.
Oh, good. So that leads me to another question then. So in addition to studying the spillover effect, I think you've also looked at other types of effects of the rise of the medium and large scale farms, perhaps on supply of foods to the urban cities and towns, maybe on the environment, on unemployment or other things. I don't know if you wanted to reflect that. So how does this particular study add to our knowledge base about the overall effects of the medium and large scale farms in Tanzania?
I don't know. Yeah, both Jordan and I are trying to give the microphone to each other. I think that's a great question, and we could speculate a little bit more on the things that we've already said, but I think the bottom line is that this is wide open and kind of begging for more empirical analysis to be done on it.
Right. Jordan, did you have anything to add, or no?
No, I really don't. On that, I mean, yeah, it's a great question. I think we need to find ways to look at it empirically.
Okay. Maybe those were my higher level ones. Maybe coming back, since we have a few more minutes, you talked about these different land concentration measures. Is there, and obviously they generate slightly different results, although it was good that they were pretty consistent in what they were telling us. But in terms of the magnitudes, I guess they were different. Is there any, what's your advice to other people looking at this area? Are there certain measures that are more useful or informative than others, or is it the case that we really need to look at all of the different ones and then try to figure out what they are collectively telling us?
I mean, that's a great question. I think, I kind of have two answers that are somewhat antagonistic to one another. I mean, on the one hand, I think that I mean, it's hard to pick winners here, right? So given the variation in kind of the analytical results, or given the sensitivity of your conclusions to the measures you choose, I think the takeaway is that you should be using as many measures as you can and kind of see if are they pointing in the same direction. Then the other answer is that when we kind of compare our generic measures of concentration, so things like the Gini or the coefficient of variation, with these more structural measures, which are looking at concentration under farms of different sizes. That's where we start to get more insights into what's going on. So paying more attention, and you know, by extension, some of the suggestions that you made earlier about looking at concentration under farms of different types or different, you know, different farming systems or different modes of production, that might be interesting and would go beyond what we've done so far. But so those 2 points. I mean, you know, look at different measures, because they're not interchangeable. But to the extent that you can take a more structural view of defining measures, then that's probably the way to go.
Mm-hmm.
Yeah, Frank, you know, if we would have stopped by just looking at the Gini coefficient as the variable of interest, and seeing the strong positive coefficients there, we would have concluded, well, the more unequal the distribution of land, the greater the sort of indirect benefits to rural households. And it wasn't until we started to, as Jordan said, to look at these more structural measures of land distribution. What's the percentage of land in the district under 5 to 10 hectares, on 10 to 20, 20 to 50? That's what led to sort of different kinds of insight, where we could see what kind of class of farm size was providing the greatest indirect benefits to other households in the area. And it turned out, you know, as Jordan presented, turned out to be, you know, the strongest positive effects were not the biggest farms. They were kind of in the middle size, 5 to 20 perhaps hectares. So I think that latter piece of an analysis nuanced a lot what otherwise might have been our conclusion if we only were looking at, you know, measures of inequality like Gini coefficients. I think we would have kind of walked away with an inadequate understanding of what was really going on.
Great. Well, that's a testimony to you know, digging deeper, and that's what I really admire about both of your works that I've read over the years. That you do that. You really try to investigate and try to find out what the real driving factors are.
Thank you.
So maybe with that, I think we can bring this to a close. I was wondering if you might want, you know, you referred to the background paper. Before we sign up, perhaps if you could give us verbally the website that or the journal where they might find your paper, that would be very useful.
Yeah, so it is under review right now, but we've got a working paper version that's available. Gosh.
If they just Google our names.
Yeah.
Okay.
If you Google MSU, IFPRI, AFRE, Jane, Chamberlin,
Okay.
and concentration.
Okay.
A combination of those terms.
That should work. Yep.
We can add the link to the recording.
Yeah, when we'll add a link to when we put it up on our website, we'll put the link under your email addresses. Okay.
Okay.
Great.
And sorry, so just one last word. I mean, if anybody does have any other thoughts about how we could go further with this analysis, or have, you know, even challenges or criticism, please do reach out, because we're interested in taking this as far as we can. Great. Well, thank you very much. Enjoy the rest of your day, and thanks for everybody online and for the questions that you sent in. And we look forward to interacting with you again in December, because we have 2 more webinars coming up. So stay tuned. Thank you very much.